So it's much more akin, although not exactly the same, but it's much more akin to printing money than it is to borrowing.
You've been printing money.
Well, effectively, and we need to do that because our economy is very weak and inflation is very low. When the economy begins to recover, that'll be the time that we need to unwind those programs, raise interest rates, reduce the money supply, and make sure that we have a recovery that does not involve inflation.
Likewise, some of the actions that the Fed is taking, as well as the TARP program and TARP 2, is this mass infusion of money into our economy. And I believe that this will cause inflationary pressures on a mass scale. Now, I certainly am not the PhD and not as learned as you, but I'd like to have your input on how we avoid rampant inflation like we've seen before in this country.
No, that's a very good question, and one we take very, very seriously. In the near term, inflation looks to be very low. In fact, we're seeing disinflation. So we don't see inflation as anything like a near-term risk. However, it is certainly the case that when the economy turns around, which it will, and begins to grow again, that in order to avoid inflation, the Fed will need to undo its balance sheet expansion, need to bring down these programs, or use other methods to sterilize the effects of our programs on the money supply. We understand that. We look at it very carefully. That's one of the chief things we look at our FOMC meetings. We want to be sure that whatever actions we take, which under the current circumstances will not be inflationary given how slack the economy is and how commodity prices have come down and so on, we want to be sure that when the time comes, we'll be able to tighten appropriately to make sure that inflation does not, in fact, become a problem. And I am entirely persuaded that stable prices is critical for long-term economic health, and we are, at the Federal Reserve, absolutely committed to assuring that.
What would you say is growing the Fed too much? Would you be comfortable growing the Fed to $5 trillion, $10 trillion?
It's the critical issue, sir, is that while the interest rate is at zero, there is no real bound because with interest rate zero, we can essentially borrow at zero or close to zero in order to finance these funding programs. But in practice, we have to worry about the fact that at some point, and I hope it's sooner rather than later, the economy will begin to recover, and it will be necessary then for the Federal Reserve to begin to raise interest rates.
So
and in order to raise interest rates, we have to, among other things, there are various things we can do, but among other things, we'll have to bring the balance sheet down to a more normal size. So all our expansion taking place at this point has to be very carefully planned to make sure that we can unwind it and bring the balance sheet down in time to raise interest rates in order to prevent any insurgence of incipient or surge in inflation.
So a $5 or $10 trillion Fed is not necessarily out of the question?
It would depend on the maturity of the loans. Longer-term loans, borrowing some other mechanism for sterilizing the effects on the money supply, we couldn't go anywhere like that. But for overnight loans, we can go pretty high.
People in my district woke up one day, sometime late last year, and found out that the world as they knew it economically was going to end because someone had done something wrong to seize up the credit markets. And since that time, they've witnessed disorder in the sense of the government's response. They've perceived this to be an unjust appropriation of their money spent on the very people who caused the problem. And they see a long-term loss of economic freedom due to government intervention. And most importantly, they don't see much benefit to their daily lives from all the things that the government has done. My concern is studying human nature is twofold. One, the concept of too big to fail. When you tell people they are too big to fail, they will, because they know there is no responsibility to be incurred, no accountability if they do. Where is the stigma? Where is for the people who failed and put us in this mess? Where are the measures taken to ensure that they pay a price for their problems that they've put onto us? I don't see any. I don't see any at this point. My second part of the question is tied to that. These people thought that they could go on forever doing what they were doing. That it would just keep going, that the dot-com bubble was replaced by a housing bubble that would never end. Now we're talking about creating a government bubble to fix the housing bubble. But they never thought they were wrong. I asked you and Mr. Paulson once what happened. The answer was mistakes were made. Well, I understand human beings are fallible. But the problem is, if people think they're too big to fail or they're too important, the hubris that enters into the prognostications that they make and the actions that they take leads them to make very, very big mistakes. So my question is this. If these people were wrong and we are suffering the consequences of their bad decisions, if people like Mr. Greenspan, who has admitted he was wrong, have caused us to suffer the consequences of his bad decision, if, as you've written a book about the Great Depression, the people at the Federal Reserve were wrong and the people at the time had to live with their bad decisions, what in the odd chance happens if you are wrong?
Well, some have raised the concern about inflation. If we don't get the balance sheet under control and the money supply under control in time at an appropriate moment, we could risk having higher prices down the road. Certainly a possibility. It's one we're very aware of and doing our best to manage. But, you know, nothing is certain, so that is one risk that I see.
Today, the Fed lowered its expectations for interest rate increases. Given that, I'm wondering if the Fed has had any discussion of altering the course of balance sheet normalization, and if you could give us any insight on what might lead the FOMC to alter that balance sheet normalization in 2019.
Sure. If you go back some years, I think people who were working at the Fed in 2013 and 14 took away the lesson that the markets could be very sensitive to news about the size of the balance sheet, the pace of asset purchases, the pace of runoff, and things like that. So we thought carefully about this, on how to normalize policy, and came to the view that we would effectively have the balance sheet run off on automatic pilot and use monetary policy, rate policy, to adjust to incoming data. And I think that has been a good decision. I think that the runoff of the balance sheet has been smooth and has served its purpose. And I don't see us changing that. And I do think that we will continue to use monetary policy, which is to say rate policy, as the active tool of monetary policy. Today, the committee released balance sheet normalization principles and plans, revised balance sheet normalization principles and plans. We have long said that the size of the balance sheet will be considered normalized when the balance sheet is once again at the smallest level consistent with conducting monetary policy efficiently and effectively. We have sought to make the normalization process transparent, predictable, and gradual in order to minimize disruption and risks to our dual mandate objectives. Today's announcement is the result of discussions over the past 4 FOMC meetings about how best to achieve these goals. The plans have many technical details, and I'll be happy to answer questions on those details, but for now, I'll summarize the key elements. Since October 2017, we've been allowing our asset holdings to decline by not reinvesting all of the payments we receive as securities mature or were prepaid. Today, we announced that we intend to slow the runoff of our assets starting in May and to cease runoff entirely in September of this year.
What in the odd chance happens if you are wrong?
Let me say a few words about our about our monetary policy operations. Funding pressures in money markets were elevated this week, and the effective federal funds rate rose above the top of its target range yesterday. While these issues are important for market functioning and market participants, they have no implications for the economy or the stance of monetary policy. This upward pressure emerged as funds flowed from the private sector to the Treasury to meet corporate tax payments and settle purchases of Treasury securities. To counter these pressures, we conducted overnight repurchase operations yesterday and again today. These temporary operations were effective in relieving funding pressures, and we expect the federal funds rate to move back into the target range. We will continue to monitor market developments and will conduct operations as necessary to foster trading in the federal funds market at rates within the target range. Consistent with our decision earlier this year to continue to implement monetary policy in an ample reserves regime, we will, over time, provide a sufficient supply of reserves so that frequent operations are not required. In response to the funding pressures in money markets that emerged in mid-September, we concluded that it would be appropriate to maintain over time a level of reserve balances at or above the level that prevailed in early September of this year. To achieve this ample level, we announced on October 11 that we would purchase Treasury bills at least into the second quarter of next year, as well as continue temporary open market operations at least through January. These actions are purely technical measures to support the effective implementation of monetary policy as we continue to learn about the appropriate level of reserves. They do not represent a change in the stance of monetary policy. In particular, our Treasury bill purchases should not be confused with the large-scale asset purchase programs that we deployed after the financial crisis. In those programs, we purchased longer-term securities to put downward pressure on longer-term interest rates and ease broader financial conditions. In contrast, increasing the supply of reserves by purchasing Treasury bills only alters the mix of short-term assets held by the public and should not materially affect demand and supply for longer-term securities or financial conditions more broadly.